What are Bitcoin blocks? Bitcoin creates a public ledger that records transactions stored in batches called blocks. But what are Bitcoin blocks, and how do they work? In this guide, we'll explain how Bitcoin records transactions in blocks and how these blocks link together to form the Bitcoin blockchain. While Bitcoin wasn't the first digital currency, it was the first to use blockchain technology. It paved the way for countless other blockchain projects, including Ethereum, Solana, and a host of decentralized blockchain applications. What is a block in the crypto blockchain? The easiest way to understand blocks in Bitcoin or other chains is to think of them as virtual containers. Each container can hold a certain amount of data. That data is generally transactions in Bitcoin, but other blockchains may include other data types. For example, in a supply chain blockchain, blocks might contain data regarding when grain left the farm and any relevant data that aids others in the supply chain. In short, blocks hold data and provide a timestamp, i.e., X happened before Y and Z. In financial transactions, this timestamp becomes essential to prevent double spending. For example, Alice has 1.5 bitcoins and sends 1 bitcoin to Bob. The Bitcoin blockchain records the transaction in a block. Alice can't send another bitcoin to Bob until she receives more bitcoin after sending the first one. The blockchain knows she has 0.5 bitcoins now. How does a blockchain block work? A blockchain is a ledger, a record of transactions. Rather than using a long list or database to record transactions, a blockchain puts these transactions into blocks and links them together to form a chain. While all blockchains use this structure, some use differing methods to agree on which transactions are valid. For this section, we'll focus specifically on blockchain technologies, specifically on Bitcoin blocks, which use proof of work as a consensus method to decide which blocks are valid. The Bitcoin blockchain uses hashing to store and validate data in blocks. Hashing refers to using an encryption algorithm to encrypt each element. Encryption is used throughout cryptocurrency blockchains, hence the moniker, crypto. Bitcoin uses SHA-256 encryption, producing a hexadecimal, letters and numbers, string from a specific input. Changing the input changes the output. Let's look at the basic elements within the block shown above. Previous hash. Each block links to the previous block by using a hash of the previous block in the new block. Timestamp. Each Bitcoin block contains a Unix timestamp, which makes it more difficult to attack the Bitcoin blockchain. This timestamp makes the blockchain more difficult to attack. TX_root Merkle root. The Merkle root is the encrypted value of all the transactions in the block. Nonce. The nonce number used only once, as a crucial part of the mining process. Bitcoin's proof of work consensus method solves for a hash based on all the block elements as well as a nonce. The previous block hash connects the blocks to form a chain. If any element from any block changes, the following blocks will be invalid. To attack the Bitcoin blockchain would require mining any block you wanted to change as well as all subsequent blocks, and doing it faster than the rest of the network can produce valid blocks. This structure and distributed ledger, combined with a worldwide network of miners, makes the Bitcoin network extremely secure. What is the role of blocks in transactions? Blocks serve as containers for transactions. However, they also act as links within the whole blockchain network. The hash of a block becomes part of the next block. Bitcoin block explorers like blockchain.com allow anyone to search and verify transactions within any block of any public blockchains. However, Third-party tools still require trust. While these tools are likely accurate, the only way to verify without the possibility of spoofed data is to run a Bitcoin node. How does the size of a block affect transaction speed? Bitcoin limits the block size to 1 megabyte. This limit, in place since Bitcoin's inception, caps the number of transactions that can be held within a block. However, rather than affecting the transaction speed, the 1 megabyte limit more often affects the cost of transactions. Let's explore how that works. Bitcoin mining difficulty adjusts based on the network hash rate. The goal is to mine one new block every 10 minutes, on average. The block size doesn't change the network speed, which mines a new block every 10 minutes like clockwork. However, the block size limitation does increase competition to be included in a block, which in turn leads to higher fees. Transactions with lower fees may have to wait in the mempool until competition subsides, at which time a miner may pick them up. However, most Bitcoin wallets quote a fee based on current network demand. Given a quote, users can either pay the current fee or wait.